Hey, good morning, everyone. Welcome to the macro snapshot for today. We are Friday, May the 29th, 2026. Okay, let's start off perhaps with just the oil market. And obviously, there's sort of conflicting sort of signals coming out of Trump and Iran. It does seem there's some kind of memorandum of understanding. There's still some sort of sticky details to be determined and finalized regarding sort of, the ultimate fate of the enriched uranium, control over the Strait of Hormuz, et cetera, et cetera. So nothing's done. Trump hasn't signed off on it, nor has the supreme leader of the Iranian Republic. But the market seems to be basically saying that in some shape or form, a memorandum of understanding is coming. The ceasefire, maybe for 60 days, is sort of more or less holding despite skirmishes. And therefore, we see that the crude oil market is actually continuing to fall. There was a couple of spikes. It's obviously volatile in terms of headlines and whatnot. But we can see here that WTI is sort of falling. We also can see that, for example, if we go over to Brent, which of course is much more affected, that's even falling more. So now down below the 200-day, the 100-day EMA here, exponential moving average here. So you can see that Brent is really coming off, but even over in the US, that is coming off. So all in all, this is a positive. We'll look at a moment in certain sort of correlations and whatnot, but basically this is a positive in the sense that as long as this sort of, WTI keeps to come down, then yields can maybe come down a little bit, and that's going to be a positive, all things considered, for the equities. So just looking at it from a technical perspective here, you can see here that the WTI we've breached the 50-day exponential moving average. And if we take sort of a longer term Fibonacci, you can see here now that we're actually starting to breach the 38% fib retracement here. So the bears at this point sort of have the ball, so to speak, to use a football analogy, and are running with it. And really, if the bulls want to do anything, it's probably going to depend really on geopolitics. But really, the issue here is when would there be sort of support? I would say there could be some sort of short-term support around about the 84.60 level. But again, it's going to be politically driven, the headlines and whatnot, and any sort of sense that really the Strait of Hormuz is going to be opened and that the oil will start flowing, and then there's some kind of sort of, sort of political sort of semi-solution. I think oil could fall further, but for sure, I think if we get around this level here, which is about the 68% fib retracement, about $77 or so, I think there's going to be some sort of medium-term support. Now, why is that? Just because that if we just start looking at just where we are with sort of inventories, just got a little bit of data yesterday. Let's just have a look here. I think I've got some data. So just kind of some of the commentary which we're starting to look at. This is from the Chevron, one of the senior vice presidents at a conference yesterday. And basically, again, this whole idea that even if the Strait of Hormuz politically, there's intention to sort of to start opening it up, inventories are down at very, very low historic levels, and it's going to take several weeks, if not months, to get sort of supply chains back into order. Now, the market is forward-looking, so the market is saying, "Hey, don't worry, things are going to be okay." But as we go into the summer driving season, I'll show you some of the inventory levels, and this is just some of the commentary. This is coming from one of the senior people at Chevron. And basically saying here, I mean, I won't read the whole thing, but commercial inventories of crude oil, liquids, petroleum, gasoline, diesel, jet fuel, they've all run down. Now, obviously, they're saying it's going to be mitigated by the release of strategic petroleum reserves, which most of the Western countries have done. All of this has mitigated the impact. You can model this. We've modeled it, et cetera, et cetera. And basically what they're saying is we're approaching unheard of levels of low inventory. I mean, really, really low levels. You could debate whether that's going to hit those really low levels in 2 weeks or 3 weeks. But once you get to that point, and this is the key thing for the market here, this is one of the senior people at Exxon basically saying that once you get to that point of very, very low levels, for example, a global benchmark like dated Brent, the model is saying that those the prices should go up to 150 or 160. So essentially what he's saying is that, yeah, for sure, maybe the Strait of Hormuz is going to open, but the reality is that we're at historically low levels of inventory. And once we get to the levels there, there's not much buffer left, and there could be a bit of a squeeze up. Any kind of disruption at that point is going to cause a squeeze up. And he's basically saying it could squeeze up to 150 or 160. That in turn would cause demand destruction. So it's interesting, basically saying that, he sort of goes on to say here that it's probably going to at least stay in the $90 to $110 for the next sort of few weeks. And that's my point, is that crude oil, even though it's coming down, there's also a certain point where inventories are very, very low, and any kind of disruption or any kind of political headline could cause things to push up a bit. So I don't think it's going to collapse to pre-war levels. And just if you actually look, this is over in the US, the latest inventory data, which we got from the US government yesterday. You can see here the 5-year range is the blue, and the 5-year average is the red. So you can see in 2026 for crude oil inventories, we're down, but not at extreme levels, but in the US, we're down at below the 5-year average. And really, where you really start to see it is if you look at gasoline inventories. That's the one. Look at the gasoline here, below the whole 5-year range, and well below for this time of the year. The 5-year average, which is the red line. So gasoline at very, very low levels. And keep in mind that in the US, we're getting into the sort of the so-called summer driving season as we're almost into June and July, and that's going to further draw down the inventories. If you also look at distillates here, you can see that that's also below the entire 5-year range and well below the 5-year average here. So distillates down, gasoline down, and also jet fuel, which I don't think I have here, but that's also down at very, very low levels as well. And if you look at Cushing, which is Cushing, Oklahoma, which is the delivery point and the pricing point for WTI. You can also see that that's well below 5-year averages and is also below the 5-year sort of complete range at this point. So the point here is that, and you can see here also the strategic petroleum reserves have been drawn down to, very, very low levels as well. So the thing here, and the other thing here is US refinery demand, which is actually very high at the upper level of the 5-year range. So the point is that US refiners are working overtime. They're churning through a lot of crude oil. And the crude oil is, sort of not bad, but really where the demand has been is the inventory levels is very low, and the demand has been very high is in all the refined products. So the point which that Chevron sort of executive was making is that although crude is coming down, it's probably going to remain relatively supported, even if we do get a Strait of Hormuz being opened. If we don't get the Strait of Hormuz open for another sort of 4, 6, 8 weeks, these inventory levels only get to extremely low levels. In some case, the lowest levels we've had for like 20, 25 years. And that could, at a minimum, cause some kind of support for oil. So it's an interesting one to be looking out for. Okay, so let's keep in mind other things. What else is going on? We had a little bit of data yesterday. So this is, in general, sort of positive in a certain sense. So if we look at some of the data we had yesterday, I won't go through everything, but basically durable goods was, relatively solid. The GDP, second reading of US GDP was sort of revised downwards a little bit. But what we're also seeing is that the labor market, if we just have a quick look here at initial claims here, you can see that that's pretty steady between about 220,000 per week. And that is indicative of a strong economy. Not a booming economy. We know that there's not a lot of hiring, but there's also not a lot of firing. And the initial jobless claims are essentially telling us that the US employment situation is relatively stable and, relatively solid. I'm not going to say super strong, but certainly not weak, relatively solid. Also, what we got yesterday, of course, was the PCE readings. Now, the headline number was relatively high, but what the market was much more keener to look at was actually the core month over month. And really, the whole point of this is this idea that the Fed is, and every central bank gets worried if the sort of headline numbers of food and energy starts to bleed into the core, and that's the so-called pass-through effects, and that's when the Fed and other central banks might have to be more aggressive. So the estimate was for about 0.29. That was the median, which we looked at yesterday, rounded up to 0.3. But what we actually got was 0.24, which was rounded down to 0.2. So the point is that the market quite liked that 0.2 number. And basically that caused a little bit of an initial kick higher with the front end of the bonds. Equities like that. Gold loved that, which we'll get onto gold in a second. And generally that was sort of considered a positive. Although I just would note that 0.24, had it been 0.25, that would have been rounded up to 0.3, which was the estimate. But nonetheless, it was a little bit lower than expected, and the market sort of liking that. So if we just look at overall and just look at a few different things here. a few different markets, we can see that that's sort of lower than expected core PCE. It was welcomed by the equity markets, and just looking at the volatility here, you can see that the VIX continues to grind pretty low levels now. We're in this sort of 15 to 16 sort of handle. That's a positive. If we also look at the bond volatility, you can see that the MOVE index has been going down for the last 5 or 6 days. So that's a positive thing. That in general bond yields are going down, but also the volatility of the yields is going down. And you put that with a lower VIX, and that means that sort of volatility targeting funds and CTAs, momentum sort of funds, they're all going to sort of start increasing their volume, which overall is a positive for the S&P. So looking at the S&P, we can see here that it's going higher. So new highs, grinding higher. This is all very positive, and that's just on potential resolution of the situation in Iran. The AI story continues to be a positive, and as long as that the oil prices are sort of grinding lower, and sort of therefore yields are grinding lower, that's going to be a positive for the equity market. And we'll look at some of the correlations in a moment. But the reality is that the AI story narrative continues to be positive. We've got the SpaceX sort of IPO coming up. We've got positive news coming out of, let's say, like Snowflake yesterday. There was like Dell had the huge new order from the US military. So Dell's shares are up, I think it was 25 or 30%, also being supported by Trump. So the point is that there's continuing sort of relatively positive news in across, sort of let's call it the technology space. And if you put that together with lower yields and a seeming resolution, even though it's going to be messy in the Mideast, that's a positivity. You also see the Nasdaq here grinding sort of to all-time highs. You see the Russell, the small caps also doing pretty well. So very, very positive sort of technical chart. And if we look under the hood a little bit, we can see that even the beaten down software, interesting that the software ETF IGV, that finally has been able to clear the 200-day exponential moving average. So that's a positive thing. Now, the fact that that's gone higher now, it could mean a little bit more upside there. So that's interesting. DRAM, which is sort of the memory, new highs. We also saw the semiconductors continue, to be almost all-time highs. Magnificent Seven, so the big tech companies looking good. So all across the technology space, sort of happy days yesterday. And just one thing we have to keep in mind, though, let's just look at some of the correlations here, just to see what's sort of also driving some of the S&P 500. So actually, just getting back on the inflation, the whole point is here, on the PC, we do have to keep an eye on inflation. As I say, it was 0.24 month over month. The market celebrated because that was revised, rounded down to 0.2. And as I said, the AI story is a positive. So at this point, the leadership is the AI, is the technology. And at this point, it's kind of saying, hey, resolution in the Middle East. But let's just keep an eye. Just got this little thing up here. How long has the PCE stayed above the Fed's 2% target? And the point is that the core PCE, it's now 62 months, so 5 years. It's been over the so-called target of 2%. Now, does the Fed, sort of, and the Treasury tacit understanding that they don't mind 3% inflation because ultimately that will shrink the outstanding debt of the US government, that will slowly sort of inflate it away. So maybe sort of there's a tacit understanding to say, hey, let's not push it down to 2%. Inflation at 3% with a strong economy is acceptable. Just keeping that in mind. But what I will just look for here is just interesting that the S&P, if you look at the correlation with US, the yields of the real yields and the nominal yields, you can see that they're anti-correlated, so opposite correlation. So what does that mean in simple English? It's basically saying that what you can observe over the last 2 or 3 months is that really as those yields are going higher, the S&P is going lower, or as the yields go lower, the S&P 500 goes higher. So the point is that the correlations have flipped sort of negative between US bond yields and the S&P 500. And again, what we're trying to say here, just to repeat it, is that that means that the S&P, in terms of the yields, if it's a healthy growth and the yields are going up and the correlations can be positive, and that's what we saw, let's say, certain parts of 2025. So it's like the stock market is saying, hey, we understand that yields are going up, but that's just because sort of growth is going up and it's kind of like a healthy rise in yields. But what the S&P and stocks does not like is when it becomes an inflation problem, which we just saw. And in that case, you see the correlations flip negative, which essentially means that the narrative, rather than being healthy growth, becomes an inflation scare. And if that inflation scare is perceived by the stock market to be driving yields higher, that's when we start getting this kind of chart, which tells us that the correlations are negative. And that's what we've got at the moment. So let's keep an eye on that. And also, just in terms of other factors driving the stocks in the S&P 500, we can see here again other correlations. You can see here that if you look at the Treasury, you can see just compared to the before the war, which was the 27th of February, you can see how it's flipped. So basically, a similar kind of thing I was showing in the other chart here. You can see that the correlations are negative in terms of the US Treasury yield. Or the US 10-year yield. And again, that's just the same way of saying that as the yields go up at the moment, the S&P 500 does not like that. Whereas, for example, with gold, if gold is higher, gold is liking the lower yields as well. When we see gold higher, we generally see the S&P 500 higher as well. And also we see a weak US dollar is a positive for the stock market. So you see here that a strong euro also, as the euro strengthens, that's generally highly correlated with a strong stock market. So just keep that in mind here. So, the stock's basically doing super well. And just to get back to some of those charts, if we look, also global equity doing quite well. And, let's looking at some of these sort of other markets. If we look at something like, let's say, sort of Taiwan, which is EWT for the ETF here, obviously a lot of semiconductors and the memory chips and whatnot. You can see that the EWT, the Taiwan, continues to rip higher. If we also look at sort of some global equity, look at the Kospi, which of course is the banner poster child for over in South Korea for sort of memory chips and Samsung, SK Hynix, and high bandwidth sort of chips and whatnot. You can see the Kospi making new all-time highs as we speak, sort of overnight. So basically, this sort of Southeast Asia, Taiwan, sort of South Korea story is still intact, and that's going to, as long as that's still intact, we have to believe like the Nikkei sort of at all time, well, basically, at high. So essentially that sort of Asian sort of technology story is going to be a positive for the Nasdaq. So, there's no reason today why we can't get a grind higher in the Nasdaq, because we're seeing it, for example, yields grinding a little bit lower. There's your 2-year yield. There's your 10-year yield now below the 4.5 level, the key 4.5% level, and the 30-year yield now below the 5% level as well. So yields coming down, energy prices coming down in the last 24 hours. That's going to be a positive for equities. Now, could there be some risks taken off as we go into Friday? Maybe, but overall, that's a fairly positive. What I would like to say as well, having a quick look at FX here, US dollar remains relatively sort of strong. So not collapsing, and that's interesting here. That's also, it is a little bit weaker, but it's still within this sort of little range. So it's going to be interesting to see here around the 200-day moving average. That's holding it in at the moment. So that's pretty much a line in the sand here. So keep an eye on that 200-day EMA for the dollar index. If we see oil continue to fade and the geopolitical risk premium fade, we could see the dollar breaking down a little bit. And again, as we've seen, that's going to be a positive for equities and let's say something like gold. But it is sort of staying in there. Just in terms of specific stories, keep an eye also on USD JPY. USD has had a pretty strong run up against the Japanese yen over the last couple of weeks, but there's starting to be a bit of intervention chatter from various officials at the Ministry of Finance in Japan. I think it's still too early for them to sort of intervene, but just that's something to keep an eye on there as well. Other thing as well, just the New Zealand dollar continues to build on that sort of hawkish hold from the Reserve Bank interest rate decision from earlier in the week. And it's now getting up to some overhead resistance, but we're not quite there yet. Overhead resistance would come in around about, almost up around about the 60-cent level. And just to sort of add a little bit more fuel to the fire, a bit of global sort of positivity is never bad for either the Australian or the New Zealand dollar. But in the case of the New Zealand dollar here, overnight we had Governor Anna Bremen essentially saying that rates were likely to rise rather than to be on hold, and that she could see the overnight cash rate, the OCR, rising further. So all that to say that the New Zealand dollar, the Kiwi, on a little bit of a tear, probably got a little bit more to go, but maybe at that point take off some of your size if you went long on that initial decision. Finally, guys, I just want to have a quick look at gold here. Gold, If we just look at the spot market, and just a quick word on that, that it's always a good idea if you're trading gold to keep an eye on the spot XAU market rather than the futures, because the futures does have interest rate embedded. It's not exactly the same thing. But what I will say here, if you look at a gold here, it did bounce off the 200-day moving average, the EMA, but also pretty close to the simple moving average here. It now faces, you could argue that this is sort of a downtrend line. It's maybe not a classic perfect one? Is it actually there, or is it more something like that? But the point is here, there could be a little bit of resistance here, but basically bounced off the all-important 200-day sort of moving average here. And gold looks as though if it can get through that sort of downtrend, it also bounced off the 61% fib level, which I drew from here. And so it could, easily test up. Probably the next resistance maybe at about 46.33, which would be the confluence of the 20 and the 50-day EMA. But so gold doing pretty well, as is silver. Silver also, actually, we'll put that on the spot price as well, XAG USD. You can see that silver here also bounced. It never actually reached the 200-day moving average, but it did bounce exactly off the 61.8% fib. And that's also sort of pushing higher. Copper is not doing anything bad either. Copper is sort of pretty solid. And just getting back to gold, I just came across some great research here, and I have to say this is courtesy of PA Global Macro. And I'm just going to show you here just some of the factors driving gold and whether, in fact, gold has more upside. So just bear with me here for a little bit here, because we have some quite interesting stuff. So basically, what we have here, actually, that's the wrong one. What we have here is sort of like a look back of the last 20 or 30 years of the factors which have actually driven gold. So pretty interesting, the different regimes here. So you can see here, by far and away. So again, this is going, again, a courtesy of PA Global Macro here, sort of going back to 1991. So we've got a look back period of about 30, 35 years or so. You can see that by far what gold likes, these are the macro regimes. If you look at annualized returns, and you can see here that a weak US dollar is definitely the strongest factor which favors a positive US dollar. And you can see at the moment, as the US dollar is starting just to consolidate and weaken a little bit, that's been a sort of a positive. Also, if the Fed is easing. So what I'm trying to understand here, and the point of all this is to understand the environment in which gold prospers, okay? And the environment, if it's not prospering, then you have a problem. So the gold loves a weakening US dollar. It loves a Fed which is on an easing path. That also, if the inflation is high, greater than 4%, it generally does quite well. And if the money supply M2 growth is over 8%, it also does pretty well if generally loose conditions. So you can see here that obviously, typically you might have a confluence of these. If you have like a weakening economy, so you have a weakening US dollar because the Fed's easing and they have loose monetary conditions, that's a perfect situation for gold. And then you can also see what gold doesn't like so much as obviously a strong US dollar down here. Gold generally doesn't do well. So if you look at over the last 35 years, on average, gold has returned about 8%. So you can see where it doesn't do well is a tight Fed or a neutral Fed. Okay, so that's the problem here. So the question is, where are we at the moment, and can gold do well? The question really is to say, well, it's going to do well if the US dollar weakens and if the Fed starts easing, which is not exactly the situation at the moment. And we have a accommodative sort of money supply. So the question is that's really what we're going to need to see to have further sort of a gold strength. Having said that, the situation here, so the variables here, and this is when Walsh was announced as the new Fed chair, and that's why they're saying January the 29th. So you can see here that basically the Fed's reaction function, you can see that the market has tightened quite a lot. And this is basically why gold sold off. So the point is here is to say that why did gold sell off over the last 3 or 4 months? And really, we can see that, once that Kevin Walsh, who the market perceived to be maybe the market tightened a little bit there, US dollar direction, the US dollar strengthened. You can also see that real rates went higher, as we've spoken about, so positive. And geopolitically, you can see that the US dollar became a bit of a safe haven because of the strengthening oil price and geopolitical safe haven. And we also had a lot of outflows from ETF flows. So these are the variables here which you really have to keep a look at. And as I was saying here, 5 regime variables, all of which flipped once Walsh was announced compared to basically sort of today. So the question is, for those of you trading gold, this is really what you have to look out for here. Can gold continue to go higher, or will it sort of be in a consolidation range? It's really, you have to look at the Fed reaction function. Is the market perceiving the Fed to be easing or tightening or neutral? Where's the US dollar? Gold loves a neutral or weakening US dollar. Real rates are remaining high, and nominal rates as well. Geopolitical, of course, is going to affect the US dollar and also the ETF flows. Because what we saw is that over the last 3 or 4 months, Western ETF flows, like in GLD, went down. So really the sort of the retail demand now is from sort of Asian retail demand for jewelry, and sort of just to put their money somewhere other than Chinese real estate in the case of China, but also central bank demand. So these are the 5 or 6 factors which you have to look out for. But the good news, though, the good news is that this is forward returns after a 200-day MA downside crossover, 19 events. So 19 times in the last 35 years, gold has gone below the 200-day moving average, only 19 times. So it's quite a rare. But the point is that on those situations here, if you look at the this is the time horizon for what it's done after its breach, and keep in mind that it did breach it a couple of days ago, you can see that overall, from 1 month, 3 months, 6 months, 12 months, and 20 months, it's a positive return. The point being, in simple English here, that gold, if it does breach the 200-day moving average, normally it basically will return a positive return for those of you more sort of investing and then trading. So that's interesting. But keep in mind, that's always happened when gold, the 200-day moving average, has been upward sloping. If it breaches it and it's downward sloping, which has happened a couple of times, that can be a bear market. Very important. So then again, so let's just go back to the gold chart and just see whether the 200-day moving average is actually upward sloping or downward sloping. And what we can see here, looking here, this is the 200-day moving average, and you can see that basically, of course, it is upward sloping. You see this sort of fat, sort of reddy orange line. Look at that, in a nice upward slope. So the point is that when it breaches the 200-day or touches the 200 moving average, but it's going upwards, generally the returns are positive. So putting that together, it's looking as though, over a 1, 3, 6 month time horizon, gold could retest higher. But in order to do that, it will need those variables, which we saw, those factors to all sort of a cluster in a positive way. Okay, guys, enough from me for today. Have a great day. Let's keep an eye on oil, a 2-year yield, gold, of course, US dollar, all of these factors, and obviously sort of headlines coming out of the Middle East. Probably over this weekend, I'll start doing like a weekly market preview, a bit more of a sort of a longer term, well, not a longer term, but sort of a more sort of overall sort of macro viewpoint. I'll probably release that on Sunday at the Macro Shop. Okay, keep an eye on the Macro Shop on YouTube and also on Twitter for some of those video updates. Thanks, guys. Have a great day. Have a great weekend. I'll be back, as I say, on Sunday. Thanks very much. Goodbye.